welcome to another episode of Bullish Banter. I hope you enjoyed the previous one where we did cover the significant piece and, of course, depth regarding the financial markets, central banks. And I believe we have had several actions and speeches from them, at least since then. Maybe, Rufus, first of all, how are you?
For me, I'm good.
Yeah.
I'm enjoying the climate change.
Excellent.
Or is it the weather?
I mean, I don't want to say where you stay,
Yeah.
but if you are in Kenya, you know the coldest place within the outskirts of Nairobi. You always have winter from January to December, so
Yeah.
I guess you are adapting to what? The floods.
Yeah, it's funny that the weather is getting cooler and cooler,
Yeah.
but the market winter seems to be ending.
Yeah.
A lot of optimism. Nasdaq almost hitting an all-time high. So things are getting very interesting.
Remember when I said maybe we might have Santa Rally?
Yes.
Yeah. Are you leaning toward that side or you are still
I
looking at other fundamentals before calling that?
Yeah, I was very positive we would probably have a Santa rally, but then judging from the current rally that we are seeing,
Yeah.
SP 500 up over 10%, Nasdaq over 10% in the last 3 weeks. It basically means that prices are a little bit overextended. So we could be seeing some form of a pullback happening around December. So there's a good chance it will be bear market during Christmas.
Yeah, let's bring it home a little bit. I believe there was a news I saw recently on the Business Daily whereby Safaricom announced increased dividend earnings. And obviously, I believe CMA is looking to cut down on the transaction charges for lending of shares. Do you believe such actions can maybe spur local investment? Because since January, we have seen net sellers of our local shares be foreigners. And some of the measures we have seen in the last couple of weeks, including political sentiments and statements, tend to incentivize, participation in the markets. Do you think maybe those two, cutting of fees, and obviously even I think one of the local stockbrokers, offered a settlement instead of T+3 to T within the day?
Well, from what we are seeing with Safaricom, I think a long-term or the long-term outlook for the shares is majorly based on the company performance. So these very short-term interventions might help a little bit with the short-term volatility. So, for instance, yesterday you saw the share price moving from around 12 to 13.5, but then that doesn't cement the entire belief in the stock. So these things have to really reflect in the Safaricom books, that is financial statement. And from what we are seeing is that the company has been reducing its profitability over the last 2 years. And at the same time, the amount of capital invested in Safaricom versus the returns they are getting is only getting higher, meaning that Safaricom is employing more capital to produce the same returns, which basically makes the investment even worse.
Given, we are covering the end of the year analysis, as we also anticipate what should and what can and what may happen next year, I think there are some fundamental, I want to call them events that we expect. Now, moving away from equities market to the bonds fiscals, we have seen, of course, local politicians, there is, of course, the executive trying to woo diaspora to participate in the local bonds market. Another segment which is really not doing okay. We know I believe in the couple of episodes back, we did analyze, of course, the logic or objective or maybe pros and cons of investing in bonds. Long-term bondholders are not the most happy of lot.
Yeah.
Recent new owners or debtors to government are quite the optimistic and the most scared lot. And it's only the infrastructure bond, the two infrastructure bond of 2023, which have had oversubscription, while the others have been having significantly low numbers. Do you think maybe towards the start of 2024, as the interest to especially the short-term bonds start maybe being paid out, will that maybe calm down the nerves of local investors, or what will be your expectations for 2024 regarding Kenyan bond markets?
Well, I think the return is quite promising. So when you see 18.5, everyone is thinking this is risk-free. I just park my money here, get 18.5. But then the real question is always something I've mentioned again and again, and this is where is the yield coming from? So looking at the Kenyan books, looking at the supplementary budget and the amount of deficit spending we are doing, then it becomes quite a challenge trying to understand where the yield will be coming from. So if the government will be forced to issue even more bonds, which resonates to expanding the monetary base, then there's a high likelihood that the Kenya shilling will continue depreciating against other assets. So on one side, investors will be getting some good returns on the investment, but then when you go to spend that money, you realize that prices have already gone up, and the net effect is that you have more money in the pocket, but you can't buy more stuff with that money. So in that case, you find that it's more like the government is taking from your pocket and then giving you back from the other side as a return. The problem is, in order to keep attracting more and more capital, then the government has to keep expanding, and it becomes a cyclical, I would call it a credit crisis, where the government has to keep borrowing at even higher interest rates in order to secure more funds to repay the existing bondholders.
Yeah.
So I don't think we are moving in the right direction.
I think that has been quite clear since the year started in terms of capital markets and financial markets in Kenya. And I know a lot of investors will be looking at their portfolio. You're looking, okay, since January, if you are a Safaricom shareholder, you have lost 20%. If you are maybe the best performing are, I think, the insurance sector, which has really performed well, but the rest are really not quite performing well. I think if you look at the American stock market as we go global, most investors you will find are investing in some companies which necessarily do not command, let's say, the clout and moat in the global sphere, but they actually do return good returns to investors. You will hear top hedge funds talking about some companies, and you're like, why are they investing in this vis-a-vis maybe in a company non-globally, like, in the cruising industry or in the, of course, the Boeings and the rest. In fact, you'll see, I think based on the latest Buffett's portfolio, he has sold a few of the Chevron and a few, big companies, which you would ordinarily be looking, okay, now maybe it's my time to get in, but they always adjust their portfolio. I think that is something, I think in comparison to that, the Kenyan market should move away, or investors should move away from the normal, Safaricom, the top five, magnificent five, plus maybe two or three. We should look to spur up the other companies, because as much as they may not really give you good returns, creating interest or demand in other companies which look good fundamentally is one of the things that local investors, maybe in what we have been doing financial literacy, should actually be looking at,
Well, I think the critical difference with the US is that the big multilateral companies who are basically serving different markets, they are finding this huge discrepancy in FX valuations. So a company like Apple, who is majorly producing their iPhones in China, doing production in India and so on, they realize that the costs or the inputs for their production are getting lower and lower because the dollar is strengthening against those currencies. So in that case, the current trends in currencies are benefiting them. But then, if you're a multilateral company that is majorly operating from the US, for instance, a software company headquartered in the US, and then you're selling your products to the rest of the world, your products are getting more and more expensive as the dollar strengthens against those currencies. So as a result, you find that your subscriptions or your client base is weakening because they can no longer afford those products. So as a result, these companies are ending up cutting their product prices in order to stimulate demand, or at least maintain the same revenue they have been getting.
Or increase their prices.
They have been cutting. Yeah. They have been cutting prices. Yeah, we also saw like Tesla cutting their prices in China. So they have to keep cutting prices in order to stimulate demand for their products. So as a result of that, it keeps on hurting their revenues.
I think one of the most significant, I don't want to call it price increase, but let's say price tampering.
Yeah.
That is Netflix, which is, I think, Kenya commands, I think, in Africa, 3.9% based on the latest data. And also they have cracked down on password sharing,
Yeah.
or, the illegal sites and everything, which is quite an indicator that they are facing significant competition back home.
Yeah.
As compared to overseas, whereby some of the content I believe they have produced are not really creating buzz around it that would spur more subscriptions. Now, sticking with that and global and FX rate, last Friday, we saw a very big rally on, I think, gold and many USD, or even in the stock market in general, after the poor performance of the bond auctions from the US. So I guess the credit crunch or the cracks, they were sealed.
Yeah.
They have started to crack again. And the bonds market is not just performing perhaps poorly in Kenya, but also in the, further.
There seems to be that correlation. So what actually happened last week is that the US was issuing this bond. It's not a unique event. It issues bonds almost every week of the year. So in this case, it was a 30-year bond sale. And then the subscription, or what we call the bond to cover ratio, was significantly lower than usual. So it basically means that investors have less appetite for lending to the US government for a longer period of time compared to a shorter period of time. So there's a couple of reasons why this is happening. On one side, it's the cycle of the rate hikes. So the US has been hiking interest rates for the last 18 months from literally 0.1% to 5.5%. So investors are growing in significantly confident that this could be the highest rate hike, and we could be seeing the Fed starting to cut interest rates, let's say mid next year. So in that case, it's not very promising. Investors want to park their money in an environment where they expect interest rates to be continuously rising, and in so doing, they get higher yield from the investment. So in this case, the investors are willing to lend to the US government for a short period of time where they know the outlook is quite stable. They're expecting, let's say, from Powell's speech, where he has been saying interest rates can stay higher for longer. They are seeing for the next, let's say, 6 months, 3 months, next 1 year, they will be able to maintain that high yield and investors will be able to secure some good return. But then, if you hold for a long period of time and you're not sure how interest rates will be changed, whether they will move higher or lower, then that basically prints an increased risk in your portfolio. So at the same time, if you think about it as a market where there are different vehicles for investment, so if you're considering bonds, you're also considering other assets. So you want to be flexible enough to be able to liquidate your bonds when there's opportunities in equities, and in that case, make profit with the faster moving vehicle.
I think today morning we were just checking the NASDAQ. Yeah. Within 3 weeks, it has wiped off almost, was it 14 weeks?
Yeah, 14 weeks.
Of NASDAQ gains, which begs the question, perhaps the negative sentiments within, of course, there is that talk of recession. There is the talk of maybe, I think right now, the chances of July, is it a June? Yeah. June cut of rates by 25 basis points is already on the table. And we are seeing the NASDAQ itself being resilient in a way, almost hitting the 2021, I think it was November highs. Same with the S&P, same with, of course, Dow Jones and the rest. While gold has already hit 2,000, I think, twice this year.
Yeah.
And looking to go back there again if all this is to go by.
Yeah.
Is the market sort of distorted to make a clear technical analysis, or there are factors whereby traders would be looking at to ensure that they are not, how do I put it, surprised by the irrational movements in the markets?
At the current price levels, if you just scan the entire broader market, you look at bonds, you look at stocks, equity indices, they're majorly currently trading at overextended levels. So if you look at the Nasdaq, it's about 5.6% away from its all-time high. It's a similar number for the S&P 500. If you look at USD JPY, it's trading at a level that was almost last seen in 1990. So very close to a multi-decade high. So when you keep on scanning different markets, you realize that these overextended price levels are currently very prevalent. So what this means is that one, there's very strong trends currently happening. And two, these overextended price levels tend to present the best opportunities for any investor out there. So if you've been following Warren Buffett and how he applies his trading, he's looking for those extremities in the markets when either people are extremely greedy or whether people are extremely fearful. So if, for instance, you've been buying USDN, the opportunity has been really nice since the beginning of the year, and the market has just been going up and up. But then the moment you get to 150, it starts getting political. Bank of Japan feels the need to intervene, to change policy and all that. So in that case, it represents the best opportunity for investors to start looking for opportunities. So for instance, if you look at NVIDIA being up, 250% since the beginning of the year. So at this point, it's going to either explode a couple of percentages higher, or at some point start taking a pullback, maybe a market correction, and that could present a real nice entry opportunity for any investor out there. So for me, whenever I see this market environment where there is too much extended prices, all I see is opportunity. Yeah.
Interesting. Now, yesterday, that would be 14th of November, CPI came out, pretty good numbers. Cost of living is going down. Of course, people have their, biased view of them. And the market rallied in a manner that you would expect maybe something like next year when the FOMC meet and they say instead of 25 basis points, they'll cut it down by a full point. That is a sort of reaction I would expect from a market. Yeah. But it was just on a numbers which it was pretty much expected because the price of oil, I think, is down almost 5% for the last 3 months. Yeah. So not really out of the question. There is no significant escalation within the Hamas-Israeli war. Is it that people or investors are switching on after the bond, let's say, lagging auction, and of course, last statements and the last week's statements of federal members, people are turning on the risk, getting away from the security, because we all know for years, U.S. treasuries have been one of those safe havens besides gold and JPY and the rest. Is it that people are now turning on the risk and getting into very exciting, quite volatile, but maybe opportunistic equities market?
Well, I would say there's a little bit of FOMO, or fear of missing out in the markets.
Okay.
Yeah, the markets have become quite, I would say, dissected. There's less of fundamentals and more of sentiment in the markets. And this can get us to overblown price levels. So, for instance, since last year, when we saw the Fed starting to hike interest rates, we know that the sequence and the talk from the Fed members was pretty consistent. On the next meeting, we are going to consider either hiking by 75, 50, or 25 basis points. But it was all the same story. We are doing quantitative tightening, and we have not yet hit that level. So investors were expecting that this tightening will continue, indefinitely until we get to that restrictive level. So inflation, on the other hand, started by topping at the highest level in the US at 9.1% in July last year. Then you had 12 consecutive drops in inflation up to, I think, July this year. This is when we had the lowest inflation rate at 3.0%. Then, for a period of about 3 months, there was a very strong rally in oil prices. I believe it was from $71 per barrel to $95. And that basically pushed inflation back higher. So as a result of that, and of course rising housing costs, we saw inflation rising to 3.2, then 3.7%. Then for the next month, it stayed in 3.7%. And investors were beginning to question whether inflation is on the rise again or whether the overall trend continues downwards. So when we saw the inflation number dropping right back down to 3.2%, close to the, I would say, 2-year low, then it basically means that the trend is continuing and the Fed is achieving its objectives. of getting inflation back to 2% target. So with that being in line, then there's this overall belief that the Fed may not continue tightening policy. So in this case, the talk of the town is now what you call a pivot, where the Fed stops hiking interest rates upwards and now starts considering cutting interest rates. So the real effect is coming from the bond markets. So bond markets are the most sensitive to interest rates compared to stocks. For instance, during all that 18-month period, we saw a bear market in SP 500, in the Nasdaq, Dow Jones last year. But then this year, we have been seeing these stock market skyrocketing higher, even if the Fed was still continuously hiking interest rates. So as you can see, there's this period where interest rates are going up, but stocks are also rising. So in that case, we are seeing that the stock market wasn't that sensitive to interest rates. But then the bond markets are very sensitive to interest rates because they affect yields directly. So in this case, if the expectation over the near future, remember for bonds, they are forward-looking. So if you're investing in the bond today, you are forward-looking to the next, let's say, 1 year, 5 years, 10 years, depending on the period of the bond. So if you're expecting that interest rates are going down, then naturally you find that demand for these bonds starts going down, and as a result, we see yields coming down. Okay. The effect of this is that if people are buying less bonds or even selling their existing bonds, then this money ends somewhere. Because if you are looking to hold on to cash, in most cases, you want to put that cash in a bond so that you have the yield coming in, even if you have that cash reserves. Yeah. Sorry for that. Majorly because, for instance, we saw Warren Buffett making about $8 billion on cash reserves only. But now, if you don't have a very good outlook for this bond market, then you sell or you stop buying, that cash ends up somewhere. So in this case, we are seeing the reverse, where now the cash is flowing towards the stock market, and then there's this sudden rise. But then, from what we're expecting on the next couple of meetings by the Fed, they will be clarifying on either of two things. One, whether they will continue holding rates that high for an extended period of time, or whether there is a rate cut coming in between for a shorter period. So in trying to determine that, then we could be seeing investors flowing back to bonds or completely exiting the bond market in order to invest in other things. However, the Fed is in a trap because they issued too many bonds, and those bonds have a lot of maturities. I believe quite a number of trillions. I'm assuming around 12 trillion over the next 1 year. So those maturities cannot be financed by tax collection. So the Fed will have to keep issuing more bonds. And in order to attract more investors to buy these new bonds to repay the earlier ones, the Fed will have to or the US Treasury will have to issue higher yields. And in that case, we expect the Fed to keep pushing yields higher. And in this case, the reverse will happen. So from what we saw yesterday, out of investors pushing money in equities and less in bonds, then we'll be seeing less money in equities and more in bonds. And as a result, I expect that the current rally is only too much overextended. At some point, we'll start seeing some pullback happening before the end of the year.
Interesting. I think this year, for those who have been listening, I think some of the actions in the markets are not visible per se on the economic calendar. They are there, like you will see the bond market auction, but normally they are marked as low impact, right? Yeah, but clearly they have had a significant rallying course because you would see the market rally even past the previous support and resistance on the technical. And if you don't understand why it is moving, it becomes really difficult for you to make a conclusive technical analysis. I guess for long-term investors, definitely very important to know what is driving the index or indices rather to the highs and highs every day, while also paying attention to the daily technicals to ensure that you're able to respect the trend patterns and structure.
Yeah, I think it's also very important for traders to tend to become more of analysts and to consider these data points that you see on the economic calendar daily as part of a bigger story. So rather than focusing on the next NFP release, next CPI release, have at least a collection of these data points. You can either extract them somewhere from the internet, or you can build your own database where you are saying that for the last 1 year, this is what has been happening with US interest rates. This is the trend in bond yields. You try and understand the overall direction and the impact of one data point versus the entire story. Because one data point is only one, I would say like a page in a book. The current page that you are reading, there's what has been happening in the past, in the previous pages, and then there's what's coming. So if you're trying to project where the market is headed, you need to look at the entire story rather than one data point. For instance, the CPI report where we saw inflation dropping to 3.2% was not just a reaction of what was announced. It's basically investors looking at what has been happening since the highest inflation rate we saw in the US up to the current level of 3.2%, and people understanding how close we are for the Fed to achieve its target of 2% and what that means for the market. So the reaction is more of an entire story other than that one data point.
Yeah, you mentioned something quite interesting that in line with bonds, we are likely to see next year not only just Kenya repaying their debt in total, and it's like bullet payments, I believe, or bulk payments for such for the investors. I guess the investors will be one of those most happy people. So probably bond market players next year, especially in the emerging economies, should this country honor their debts, they should have a good year where most people are sort of predicting the deflation to continue, leading to perhaps a recession in the economy. Now, that means also the US election will come into play because, as we have seen, the previous House Speaker McCarthy would not honor the Republican hardliners on increasing the debt ceiling, which I believe is not really something that we should be there, because if you have a debt ceiling that can be, removed anytime, then why have it, So
of course, the debt ceiling in the US is always more of a suggestion rather than a limit.
And the government spending in world over always overextends itself. What I'm alluding to, in the next year, I would recommend to traders, just try to follow once in a while. You might not necessarily look at CNN or all the debates that is going on, but understanding the leading candidates' economic, let's say, philosophy. Do they prefer higher interest rates? Do they prefer lower interest rates? Do they prefer higher taxes? Do they prefer maybe a restrictive tariff basis? Will play a big role in what to expect, not only on, is it 8th of November next year? But also in the coming next years in how the markets will be moving, because their policies and their legislation agenda will drive the markets to whatever level it will be.
Yes. For instance, when Biden became president, we knew that Democrats have this approach of overspending in the economy. So they try to expand government and offer more services. And as a result of that, we have seen stocks benefiting from that. So he kept printing more and more cash. Even when inflation was high, he actually passed an inflation reduction bill that allowed him even more spending, which basically led to more money within the system, which led to higher inflation, but at the same time also higher valuation of equities. So if we happen to see, let's say, a leading candidate in the Democrat side, there's a high likelihood that government will continue expanding, and this could lead to even higher performance of equities.
I think I'll call it that perhaps in the next 3-4 years, the US debt will be around 40 trillion, up from whatever 33 or 32 trillion debt that they have at the moment.
In that case, you are assuming that the Democrats will win.
I'm just saying, whether the Democrats or the others win, I still think they'll hit them. Away from that, as we sort of come to the tail end of this, recently, the last couple of weeks, Bitcoin, crypto markets in general, two things have happened. False information of filings by, let's say, executives of the top hedge funds like BlackRock. Secondly, I believe next year there is this concept of halving. Maybe you can elaborate on that. And finally, top leading, presidential aspirants have been talking that the regulator of SEC is quite stringent on a technology that will come either way. So maybe adopting policy measures that are quite friendly to innovation and while also protecting consumers would be in line instead of policing the technology. What is your take on all of this?
Well, I think one of the biggest controversies in the digital assets markets has been the approval of a spot Bitcoin ETF. So, out of banking and other financial institutions have been pushing to get these approved, but somehow the regulators in the US have not been able to approve this. So there's been a lot of fire on Gareth Gensler to approve at least one spot Bitcoin ETF. And this would fundamentally allow institutions to at least have a direct exposure to Bitcoin. So a lot of companies that have very strong interest in Bitcoin have been using other routes to get exposure in Bitcoin. So one of the routes includes buying companies that are doing Bitcoin mining, like Marathon Holdings. Others have been buying this Michael Saylor's company, trying to get an exposure because the company was Bitcoin. So if you don't own its stock and it makes profits on its Bitcoin, then you also get a profit. Mm-hmm. So that has been working quite well for those companies, but they want more. They want to have direct exposure, especially for the ones in banking and investments. They want to give their clients exposure. So since there is no regulations for that, then they want that spot Bitcoin ETF approved so that they can get that exposure. So a lot of investors have been weighing if these guys, looking at the number of holdings they have on their funds, if they add this to their portfolio, then there's a high likelihood that it could pump prices higher. So on the halving side, we know that Bitcoin has this 4-year cycle where miners get half the rewards. So if miners are getting, let's say, 50 Bitcoin, if block mined, mm-hmm. So you mine a block, you get 50 Bitcoin. So after 4 years, that emission is cut by half. So now the emission goes to 25 Bitcoins, and then down to 12.5, then 6.25, yeah. and so on and so on. So in this case, we are looking at a Bitcoin halving cycle. So the effect of this halving cycle is that for the people supporting the network, they will be getting less rewards. So the rate of inflation in Bitcoin, or the amount of new Bitcoin added to the market for that 4-year cycle, will be half the previous one, which means that there is lower supply. And of course, scarcity brings in value. With a particular commodity that becomes more and more scarce, then the price tends to move up. So in this case, we normally get this halving cycle leading to a big rally in a Bitcoin price. Mm-hmm. So in this case, a lot of investors are anticipating, but that if there's a spot Bitcoin ETF approved, and then the halving cycle coincides with that, then they expect the price to explode higher.
I guess that is similar to reverse stock split, right?
No.
The concept basically whereby you have let's say 1 million. Normally stock split is 3-1.
Yeah.
You have one, you get split into 3, the prices go down, right?
Yeah.
But if you do a reverse stock split, you reduce the stocks issued,
yeah.
And also maybe it might not necessarily pump the value up,
yeah.
But at least there is less out there, so you sort of manufacture demand.
Well, I kind of disagree with this, because I think a reverse stock split and a stock split doesn't do anything to the valuation of the company.
Okay.
The way I would describe it is, let's say we use an example of a central bank. So let's say the Central Bank of Kenya has been issuing bonds worth 100 billion every year. If they have this policy where they are having this issuance every 4 years, so let's say at one point the central bank is issuing let's say 100 billion, then it halves that to, let's say, 50 billion, and then keeps on reducing. Then you can see the currency issuance being smaller and smaller.
Okay.
So that would have the impact of strengthening the currency every 4 years.
Interesting. Yeah. Because I'm talking about it because I know some people also dabble in not only the Bitcoin within the exchanges, yeah. But I'm sure some within the MT5 FX Pesa platform do try to take advantage of some of the coins in regards to CFD leveraged aspects of it. So definitely that's some elevated volatility, but I'm concerned because, some of the talk or the drivers of the price action is mumbled up with a lot of misinformation, which is quite risky for obviously objective price analysis.
Yeah, there's also this issue where there's this expectation that central banks having tightened policy over the last 18 months, and I'm talking about major central banks. So this has led to this debt cycle where they have to keep issuing even more bonds in order to pay the earlier bondholders. And as a result of these, there's an overall expectation that over the next 2 years, we'll have these central banks printing more and more cash. Like the printers will literally go brrr. So knowing that this might happen, investors are trying to find a safe haven asset where the supply is completely limited. So this is what might explain the current array in Bitcoin. Of course, we are seeing other safe haven assets such as gold and silver being on the rise.
Yeah. Interesting. I guess we'll have to wait and see what happens. For me, after CPI now, I'd want to see how the market reacts to PCE, personal consumer expenditure. That would be quite interesting to watch. I hope that would, and obviously consumer, the sales.
PPI. There's also PPI, producer price index.
Yeah, that is okay. But I think I'd want to see the sell side of it because we're in Black November. Whoever is partaking in it, I know different. It has been high, but whatever happens, I want to see that because it will illuminate a little bit on how people are dealing with the high cost of living across the board. While also I'm not quite convinced because this is just 1 month number. If the price of oil were to rise this month to 90, that would definitely not. So I want to be optimum on CPI.
Yeah.
Let's say within the next, say, 3 months or so, then I'm convinced that, okay, now we have dealt with inflation.
Well, there has been this realization this year where we expected that according to, Kenyan economics, that if interest rates rise, you'd naturally expect people to be borrowing less money, and that would lead to a tightening of some sort in the US economy. However, from what we are seeing, interest rates have been rising. They have currently hit 5.5%. Mortgage rates are up there around 8%. And instead of Americans cutting their consumption, they're actually taking even more credit card debt. So we saw US credit card debt hit 1 trillion for the first time, and it's currently moving even higher. So as things get tougher, the average American is borrowing even more to maintain the same standard of living. So at this point, we may see stocks being extremely strong because demand has been resilient. People are taking even extra jobs to maintain the same kind of living. And as a result of that, we have seen unemployment being pretty stable. I remember Jerome Powell saying that the job market is currently very hot. But if you dive deeper into the numbers, you realize it's even people taking more jobs so they can maintain that lifestyle. So the problem comes with these debts, the credit card debt they are taking, the mortgages, and so on. So at some point, the burden will become so huge that people will start defaulting on other debts. So you could be seeing defaults rising, especially in the commercial real estate, residential real estate, on credit cards. And when that moment comes, I think that's what has been the key market indicator for potential recession. So as long as the consumers can access credit, they can access extra jobs, and they can maintain that demand across board, you'll see record earnings in Microsoft, Google, and all these big companies. But then at some point, the buck has to stop somewhere. And that has been postponed from this year to perhaps next year. But that moment of reckoning is coming.
Yeah, so that we don't sound like the, prophets of doom.
Yeah.
We hope you as a retail trader, you are able to, adapt your strategy and obviously your positions with the changing market dynamics. And for me, I think this year has been quite an interesting year in trading. Good highs, bad lows, but obviously that is the market. You learn every session. I hope you have learned one or two things, unless you have closing remarks or, some hint.
Well, as I always say, for us as retail traders, we don't partake. We don't cause any of these events. We do not enjoy or celebrate them. So all we do is to react to what the market is telling us. So in this case, the market is showing us a very strong stock market boom. So over the next 1, 2, 3 weeks, we could be seeing some further extensions in these rallies, and we can take advantage of that, but be very concerned about the opposite happening. So my closing remarks is thank you to everyone who participated in our financial literacy journey. I'm proud to announce that FX Pesa has hit over 1 million people in terms of financial markets education, and this has been quite a successful year for us. And of course, make sure to subscribe, share your commentary, and if you have any questions, feel free to type them on our socials, and we will be happy to respond to these questions.
Excellent, excellent. Adios, guys.
Adios.